Your stop isn't getting hit by bad luck. It's being hunted. This is one of the most important things I'll tell you in this entire course. And once you understand it, you'll never look at a stop loss the same again. Every swing high has retail stop losses sitting above it. When price breaks above a swing high, traders who are short get stopped out. Their stop loss and order to buy triggers automatically. Every swing high has retail stops sitting just above it. When price breaks above a swing high, traders who are short get stopped. This is liquidity, resting buy orders sitting just above the high. The same thing happens below swing lows. Traders who are long have their stops just below. Price sweeps the lows, their stops trigger, and prices reverse. Here we go with an example. Okay, so retail stops are sitting here, here, and here. Okay, what happens? Price reverses, comes out, and this happens. This candle here takes out those stops. All right, this candle here takes out these previous stops. And this candle here takes out those stops, right? It's taken out all the liquidity. Every single blue line you see is where prices reverse, and it's just coming up and taking liquidity. And then what happens when it's taken all liquidity? It drops back down and then comes back up. And what does it do? It hunts this liquidity now. So this candle here is now taken out the stops that were resting behind here, right? It comes down. A lot of sellers are going in. Again, we've got a move where we're going to the downside. We pull down, we pull back up. That's a lower high. We pull down, we pull back up. That's another lower high. And look what happens. We reverse out of there, and all these areas get taken, right? There's another one here. This candle here takes out all these previous stops. Price pulls back down, goes back up. This area here takes out all these stop losses sitting at the top here, right? It's a continual pattern that unfolds throughout the market. Again, here's a low. Price pulls back down. There's some lows. What happens? Price pulls back. You can see that wick there, this one right here, and it takes out all that liquidity right there, right? This is a concept that just keeps playing out over and over throughout the day. Institutional traders need the other side of large positions. They can't just place $1 million buy order. There aren't enough sellers at one price to fill it. Below the swing lows where stop losses are sitting, your stop loss is their entry. The high and low of the Asian session form a range. These are the first levels that are likely to be tested during the London. Level 2, previous day high and previous day low. These are major resting liquidity zones. If price sweeps the previous day high, that's retail long stops being triggered. Institutional orders being filled. Level 3, previous week high and previous week low. Less frequently swept, but when they are, the move that follows is significant. So as you can see, let's have a look at all this, right? So we've got Asian highs and Asian lows. London opens, takes out Asian highs, comes back, takes out Asian lows. Let's have a look at our previous day low and our previous day high. Previous day low is this pink line down here. It's got PDL, previous day low. We have previous day high up here, which is PDH. What happens is we come down and through that in the New York session, and then we rally to the upside. We then go straight through the previous day highs. As I said before, previous day high and low, previous week high and low are less frequently taken, but once they are, the move is significant. As you can see, that is from the previous day low to the previous day high. That's 470 points for that just one day. So when they are taken, they are significant. They are areas to look for. But In the short term, what you want to be looking at is the session highs and lows. Valid sweeps versus breakouts. This is the critical distinction. A sweep looks similar to a breakout, but they are opposite signals. A sweep is when price moves beyond the level, wicks above or below it, and closes back inside. Volume may spike on a sweep candle. Look at this. Price pushes to the upside, out of the Asian range. It takes it. Let's go down and have a look at that on a 5-minute. Look at this. Price pushes above the Asian session briefly. Then the candle closes back below. Retail longs who were buying the breakout are now underwater. Retail shorts had stops above that high, which are now taken out of position. That's a manipulation. That's the signal. All right, you can see here we've come up, we come back, and we come up, and we come out of that area of Asian highs. And then we pull back down here below the Asian high line, and we continue to the downside, and then we take out Asian lows, which are resting down here. So we've taken out anyone that's going short up here. Anyone that had their stop above Asian highs has been taken out, and anyone that's had their stop below Asian lows and have been going long are then taken out again. A breakout, price moves beyond the level of candles. A breakout, price moves beyond the level and candles continue in that direction. Multiple consecutive closes beyond the level. Volume is sustained. The difference is the close, right? The sweep closes back inside, the breakout closes and holds beyond. I only ever trade the sweep. I'm not interested in the breakout. I want nothing to do with the breakout. I'm all about the sweep because I know if we've taken liquidity to the upside of the Asian session, then we're targeting the downside of the lows of that particular Asian session. The sweep is the signal. The most important thing to understand about liquidity sweep strategy is this. The manipulation is not the entry. The manipulation is the signal that the entry is coming. When the Asian highs get swept, I don't rush in for a short. I wait. I watch for a break of structure to form on the reversal, and then I look for the fair value gap to get retested. So if we have a look at this one, right? So we have, let's go to the 3. So if we have a look at this break of structure fair value gap, okay? So we have break of structure right here. We actually get this one right at the top, okay? There's a couple of points that you get. So this one here is break of structure. And this here is break of structure as well. Right, what happens? We've got 2 points of break of structure. We come down through the first one, we put in that fair value gap. Right, draw that fair value gap out, and what happens? Price tests into it, rejects it, and then runs down to Asian lows. That there is a really, really nice trade. Again, we put our stop at the highs, and we target the lows, Asian lows. That is a 1 to 8.57 just sitting there with a sweep of liquidity targeting resting liquidity at the opposite side of which you just took that trade. That is a fantastic trade every day of the week. Low risk, high reward. That is what this course is based on. You'll find throughout this course that we hit very high numbers, risking very little and getting rewarded very greatly, very highly. What I've found over the years, especially earlier on in my career, I was panic selling, right? I was getting into trades with 1 to 1, 1 to 2, 1 to 3 even, all right? And every time I was wrong, if I was a 1 to 1, then I had to get 2 more trades to make up for that one loss. If I was a 1 to 2, I had to get another trade and then trade again to recover my loss. You find that you drown in your mistakes. Whereas if you look at this, we risk 1% for this particular trade and it runs for a 1 to 8.57. All right, that means that there's 8.57% and I'm trading 1% trades every time, it means I can be wrong 8.57% before this one trade will be taken out of my P&L. Do you see that, how that works? It's a completely different concept, right? There's, you know, in our Discord, we're doing 1 to 10s, 1 to 15s, 1 to 22s every once in a while. Like, they're really high numbers. But what that high number means is you have the ability to be wrong in your strategy. Okay, it allows you to absorb a couple of losses and still profit. Okay, so even if you got 4 wrong in a row, that's 4%. But then you hit something like this and you're still going to be up 4.57%. That's a huge, huge margin. Go back and look at a week of NQ price action with fresh eyes. Every morning, find the Asian session range. Watch what happens to those highs and lows during London. You will see it everywhere once you know what you're looking for. Episode 6 is the break of structure plus fair value gap, the entry trigger that runs through every strategy in this course. We use this entry model a lot. It is really powerful and it is pretty much foolproof. I'll see you then. Ciao.